Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Well, good afternoon, everybody, and welcome to another episode of Reynolds Wrap. Joining me is my great friend Corey and business partner, Mr. Stilp.
Hi, everybody.
So today we thought we'd talk about what I consider to be opportunity time. And what we mean by that is Roth conversions. You've heard us talk in the past about opportunity, that historic low tax levels.
Yeah.
I know a lot of people have a hard time believing that, but the fact is, folks, we truly are in historic tax levels. And I know you've heard us mention in the past about what's coming as the end of 2025, the tax President Trump's tax cuts are going to sunset as it stands under current law, December 31st, 2025. And then we're going to revert back to 2017 taxes.
Yep.
And a lot of you, it's been so long, might not remember that, but they're not very pretty. I can just tell you that. You're going to pay a lot more taxes. There's no question about it. So we believe opportunity is knocking at the door right now.
Absolutely. Absolutely. Good point, Don. And before we kind of get into a Roth conversion, I just want to make sure our listeners understand the difference between a Roth conversion and a Roth contribution. So a Roth contribution, you have to have earned income, and that's where you're contributing new money to a Roth IRA. What a Roth conversion is just reclassifying a traditional IRA or qualified money where it's pre-taxed into a Roth IRA. Now, the year that you convert it, so let's just say as a hypothetical example, someone has $100,000 in a traditional IRA and they want to convert $30,000 in 2023. So in that year, 2023, they take $30,000 and move it from the traditional IRA to the Roth IRA. That $30,000 is taxable income to them in 2023. But now you've got the $30,000 in the Roth IRA that has all the Roth IRA rules around it, and you've got $70,000 left in your traditional IRA in my example. So again, that's the difference I want to make sure you understand. But as Don mentioned, with our historic low tax environment that we're in, there is a great opportunity to look at potentially doing some Roth conversions in 2023, 24, and 25. And then depending upon what the law will be in 26 and thereafter, or if they extend the sunset, you may want to look at opportunity to continue to do so.
Absolutely. And in fact, if you've ever listened to some of our podcasts, it's been a few years ago, but we actually did a event podcast with Ed Slott, and he's, what I would say world-renowned, the guru about, IRAs, if you will, and Roths and the whole thing. And I always tell people, don't take it at our face value. By all means, go listen to the quote-unquote expert, Mr. Slott, in one of our podcasts. But he clearly tells people there's never been a better time to convert money than there is right now because of the low levels in taxes. Now, one thing we want to caution people, you have to understand that all of the information out there that says when you convert money to Roth, you have to pay the taxes outside of the dollars. So what we mean by that is if you convert 30 and you owe $7,000 in taxes, you don't get the $7,000 out of the 30 and pay the tax and end up with 23 in the Roth. Terrible decision. Don't do it, because now you're losing the time of money and the compounding on that $7 that you gave to the IRS. So what we're saying, in essence, is if you got savings, non-qualified money, an investment account, you pay the taxes out of those dollars, not the money that you convert. And again, go listen to Ed Slott. You can go to 800preserve.com. and click the podcast, and you can find Ed Slott in there and listen to it. We highly recommend to do that. It's just as another source of information.
Yeah. And one thing, too, that a lot of listeners need to understand is what we call the widow trap. A lot of times in a married situation or a couple situation, if there is a survivor in that relationship, in that retirement, we get to a single tax filer. Make sure you understand what we call widow trap. In other words, going from a married filing jointly to a single tax filer is absolutely in my opinion, not the right move that the government does for us, because the tax brackets, you accelerate through them at a much faster rate. And if you're used to a certain level of income and you want to have that income as a single tax filer, your tax bill can often go up by a large percent. So having Roth money in this conversion that we're talking about can have an opportunity to have the same income, but have a portion of the income be tax-free. So often in our planning, what Don and I will do is we'll look at a Roth IRA and we'll have that be for that untimely event when there's a survivorship. And now we use that money to supplement the income, lower your taxable income, and only take out the minimums or mandatory of your qualified money left. But again, increase some of your Roth withholdings now as far as taking contributions. And you manage your tax event as a single tax filer, and you don't have an increase in your taxes. Yep. So again, there's great advantages to accumulating Roth IRAs, and this is a great time to look at Roth conversions. So if you have questions or you'd like to look at your personal scenario, please do give us a call. We'd be honored to sit down with you and show you what a Roth conversion will look like in your personal situation. So feel free to call us at 651-773-3859. Again, 651-773-3859.
No, that's a great point, Corey. You maybe heard us talk about this. We want to help you learn how to control your taxes. Don't let your taxes control you. And as a single tax filer, there's no question what Corey said is very real. It's very painful for people. And most people never prepare for that. They don't realize that. They don't understand what's coming. And with our software program that we have, we can actually show you, if you will, the cause and effect of that when you lose a loved one, and really what happens to you with taxes. And that's why we always recommend with our clients, Roth dollars are the last dollars we ever want to spend. We're really, like Corey said, saving that for that day when you lose your loved one to supplement the loss of income. Because remember, married couples are going to lose Social Security, one of them the lower benefit. And, if you got pensions, potentially there could be some loss of dollars in there too. So it's imperative to plan for that long-term day, because it will come. We're all going to go to our maker, as we know. And so we want to do our best to plan in the most tax-efficient way for our clients. So with that, again, like Corey mentioned, feel free to give us a call, and we're happy to talk with you over the phone, or you can have a 1-hour, what we call discovery meeting. It's a complimentary, no obligation meeting with us. And you can give us a call at 651-773-3859. Again, that's 651-773-3859. With that, I want to thank you all for attending today, and we hope you're enjoying the information that we're sharing with you. Make it a great day.
Have a great day, everyone.
Listen to more with Don Reynolds and Corey Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.